Many borrowers who are in default and behind on their loan payments are unaware of the negative consequences of defaulting on their loan. As a real estate investor, it's important you help them understand what those negative consequences are. By doing so, they will be more open to explore different ways you can help them avoid foreclosure from happening, including selling you their property. So on this video, get ready to learn the 5 negative consequences of foreclosure that every investor should know coming up.
For a limited time, you can get a free copy of Jerry Norton's Quick Start Kit with everything you need to flip your first house in 30 days or less. Download it now at myquickstartkit.com.
If this is your first time here, my name is Jerry Norton, and I've been a full-time real estate investor now for over 17 years. Amongst other things, I specialize in flipping houses all across the country, and I've helped thousands of new investors get in the game of flipping and create 6-figure and even 7-figure incomes. If you want to learn how to flip houses so you can live your dream life, be sure to subscribe to my channel and click the bell icon to get notified when new videos are released. Welcome to a special video series where you're going to learn everything you need to know about foreclosures, which are perhaps the most common type of distressed real estate properties that investors can pursue. And since you'll be working with sellers who are in some stage or phase of foreclosure, it's important you know how to help them. First and foremost, when a borrower defaults on a loan, foreclosure is the legal process for the lender to take possession and sell the property to recover some or all of the amount owed on the loan. Due to a variety of reasons, foreclosures are a fairly common occurrence. According to RealtyTrack's U.S. Foreclosure Market Report, as of May 29, 2020, there were over 330,000 properties in some stage of foreclosure in the United States. It's worth noting that not all foreclosures are involuntary due to hardships such as job loss, where the borrower is unable to continue making loan payments. Some borrowers voluntarily or strategically default on their loans. This usually occurs when the property is upside down, or in other words, the value of the home is less than the amount owed on the loan. When a borrower owes more than it's worth, he often makes a financial decision to voluntarily stop making payments, even if it's within his ability to stay current on the loan. This happened in droves after the 2008 market crash, where over-leveraged borrowers walked from their upside-down loans. The thing is, whether involuntary or strategic, for a homeowner, a foreclosure has negative consequences that they may not be fully aware of. You can help by making these negative consequences known to them in an effort to help them make the best decision about their property. There are 5 negative consequences. Let's discuss each one. The first negative consequence could be very severe. Depending on the state, the lender could seek what's called a deficiency judgment. The deficiency is the difference between the borrower's total debt and the foreclosure sale price. For example, let's say the total debt owed on the loan is $200,000, but the home sells for $150,000 at the foreclosure sale. The deficiency in this case would be $50,000. And in some states, the lender can seek a personal judgment called a deficiency judgment against the borrower to recover the deficiency. Once the lender is awarded a deficiency judgment, it now has to collect that amount from the borrower, in our example $50,000, by following normal collection methods like garnishing wages or levying a bank account. But like I said, it does depend on the state whether or not the lender can seek a deficiency judgment. For example, the state of California has anti-deficiency laws, but the state of Florida doesn't. So if you'd like to see a list of all 50 states, I'll put a link to a chart in the description below for you. The second negative consequence of a foreclosure for a borrower is difficulty getting a new loan in the future, and that makes sense, right? Someone who defaults on a loan is now a high-risk borrower. Most lenders, such as Fannie Mae-backed mortgages, won't lend to borrowers with a foreclosure on their record for 7 years from the date of the foreclosure. The third negative consequence of a foreclosure is a significant drop in credit score. According to FICO, for borrowers with a good credit score, a foreclosure can drop their score by 100 points or more. If their credit is excellent, a foreclosure could reduce their score by as much as 160 points. Basically, the higher your credit score, the more impact a foreclosure will have. A low credit score equals high risk, and if able to obtain credit at all, he will pay a much higher interest rate. Okay, the fourth negative consequence of a foreclosure is much more impactful than just a lower credit score. A foreclosure on a person's record can prevent him from getting credit altogether for other types of non-real estate loans, such as purchasing a car. Similar to bankruptcy, a foreclosure is treated like a major red flag when it comes to obtaining credit, and it doesn't go away anytime soon. According to credit reporting agency Experian, a foreclosure remains on a credit report for 5 to 7 years from the date of the first missed mortgage payment. And the fifth negative consequence of a foreclosure is often overlooked, and that's the tax implications. Anytime debt is forgiven, it is considered a taxable event. The IRS states that any borrowed money that is not paid back is considered as income and is taxable. So let me try to explain this. A mortgage involves a borrower receiving funds from a lender to purchase a home in return for a promise to pay the funds back to that lender. When the borrower begins repaying the loan, the borrowed money is not claimed as income on the borrower's tax return. If, however, the debt amount is canceled or forgiven, it will have to be included as income for tax purposes. The loan amount is considered income because there is no longer an obligation to repay the lender. In other words, you received money that you are no longer paying back, so now it's considered income as far as the IRS is concerned. Now, I hope that makes sense. Once the property is sold by the lender, the tax consequence comes into effect. If the property is sold for less than it was originally worth, and the bank is unable to recover all of the money it had lent, the balance is reported to the property owner and the IRS as a cancellation of debt or Form 1099-C. In the example used earlier, if the loan was for $200,000 and the property sells for $150,000 at the foreclosure auction, the difference of $50,000 is considered as income and must be reported on the homeowner's income tax return, which may be subject to capital gains and income tax depending on the person's tax bracket. So depending on that situation, as an investor, you have an opportunity to help homeowners avoid foreclosure. If the seller is experiencing involuntary default, such as a job loss, and can't make the payments, assuming there's enough equity, you could offer to buy the property for cash and either fix and flip it for profit or wholesale it to another flipper for a fee. And I did a video that explains how to wholesale and flip properties that have mortgages. I'll put a link to that video in the description below and you can check it out later. If the property doesn't have enough equity to buy for cash, you could still help the seller avoid foreclosure by doing a creative financing strategy called Subject To, where you bring the loan current and take over the loan. And I did a video that explains in detail how to do a Subject To deal. I'll put the link to that video in the description below for you as well. Now, the key is being able to find and contact sellers before it's too late and they lose their properties to foreclosure. This is called pre-foreclosure, and my deal management system, Flipster, has pre-foreclosure leads that you can contact. Now, if you've never heard of Flipster, it's an all-inclusive cloud-based system to help you organize, streamline, and automate all of the steps to wholesaling and flipping houses. To learn more and see it in action, just go to getflipster.com. And to help you know exactly what to say when talking to sellers in default, be sure to get my word-for-word scripts. Best of all, I'll give those to you for free. Just go to freesellerscripts.com. Finally, be on the lookout for another video in this series where I'm going to break down the 6 phases of a foreclosure that you need to know. Now, this is important because you have an opportunity to help a homeowner in each of those 6 phases. And if you haven't yet, be sure to subscribe to my channel with over 725 videos. This is the #1 channel on YouTube for all things flipping, and I'll see you on the next video. Hey, Flippy G. Hey, Flippy G. How we doing, puppers? How we doing, puppers? Oh, you good puppy. What you good puppy?